Zillow thought they could outsmart the housing market, and for a while, it looked like they might pull it off. They had the data, the brand, and billions of dollars to burn. But instead of becoming the ultimate house flipper, they ended up lighting money on fire, losing hundreds of millions of dollars, laying off thousands of employees, and tanking their stock price by more than 80%. And the craziest part, most of it was self-inflicted. Now, on the surface, you guys, the story starts small. Back in 2018, Zillow dipped its toes into house flipping with a program called Zillow Offers. You could punch in your home's details online, their system would spit out a number, a pricing analyst would double check it, and within 48 hours, boom, you had a cash offer. For homeowners, it felt almost too good to be true. Fast, convenient, almost no paperwork. It seemed like Zillow had cracked the code. I even remember when there were Zillow for sale signs popping up in my neighborhood. At first, the numbers were modest. A few hundred homes purchased in their pilot markets, a few dozen sold. They lost money, sure, but nothing catastrophic. For a company of their size, it was basically pocket change. But then came the bold move. Zillow's leadership decided they didn't just want to play in the housing market, they wanted to dominate it. Instead of scaling cautiously, they set an almost ridiculous target, 15,000 homes per quarter. That's 60,000 homes in a year. Renovated, resold, and flipped like clockwork. Think about that for a second. They went from a few hundred homes in their first year to promising investors tens of thousands practically overnight. And the reason wasn't just ambition. Their rival Opendoor had already raised over $1 billion and was gobbling up the market share. Another competitor, OfferPad, was growing too. Zillow didn't want to be left behind, so instead of building slowly, they hit the gas. But here's where things started to unravel. To buy houses faster, Zillow made a key change. They stopped relying on human judgment. At first, analysts would just adjust the algorithm's estimates to reflect real-world conditions. You know, stuff like how a home felt, the view, the neighborhood, or whether it was sitting next to a freeway. Sweep those things under the rug. But in the rush to scale, they put almost total faith in the algorithm. And that algorithm had a big problemo. It wasn't just analyzing market, it was influencing it. Zillow started making aggressive offers, sometimes 10 to 20% above market value. When you're talking about hundreds of thousands of dollars per house, that's not a small difference. The more they overpaid, the more the algorithm interpreted that as proof that home prices were rising. So it started offering even higher prices. It was a feedback loop and it got out of control. This is the point when a lot of people tuned in and thought, wait, aren't these the people who build this estimate tool? Don't they have the most data of anyone in the housing market? How could they not see this coming? And that's exactly the issue. They trusted their models more than the market itself. Meanwhile, the housing boom of 2020 and early 2021 gave them false confidence. Interest rates dropped close to zero, buyers flooded the market, and prices spiked double digits in a single year. To Zillow, it looked like their strategy was bulletproof, but buy high, sell even higher until the market cooled. Suddenly, buyers disappeared, affordability hit a wall, mortgage rates ticked back up, and Zillow was left holding thousands of homes they had badly overpaid for. By the end of 2021, 2/3 of the homes they were trying to sell were listed below what they paid. Average discounts about 4.5%. That adds up when you're dealing with thousands of properties. The losses piled up to more than $800 million in 1 year alone. And here's where it gets interesting. Their competitors, Opendoor and OfferPad, they suffered too. They all saw revenue collapse as the housing frenzy cooled off. But Zillow, because of their aggressive scale and faith in the algorithm, got hit the hardest. They weren't just behind, they were humiliated. By 2021, the company had to shut down Zillow Offers completely, fire 25% of their staff, and admit to investors they couldn't predict home prices accurately enough to make the model work. Now, you might be asking, why does this matter today? Zillow's still around. The stock still trades. People still use it every day to browse homes. But the story reveals a bigger truth about the housing market right now. The moment you start treating homes like commodities, the market punishes you. Real estate is messy, emotional, hyper-local. No algorithm can perfectly capture that no matter how much data you have. And for investors, this is where the lesson comes in. When even Zillow with billions at its disposal couldn't make flipping work at scale, what does that say about the risks for the average investor trying to play the same game? It's a reminder that the housing market isn't just numbers on a spreadsheet. It's jobs, incomes, interest rates, and yes, sometimes even the, quote, feel of a home when you walk through the door. By the way, if you want to keep an eye on these kind of shifts, not just the flashy headlines, but the real under-the-surface data that tells you where the market's actually moving, That's exactly what we track in the Deal Watch. It's our newsletter where we break down inventory changes, under-the-radar prices, and early warning signs that bigger firms usually keep for themselves. There's a link down in the description below. It's completely free. Go ahead and check it out. But let's bring this back to Zillow. The downfall is also a warning for today. Algorithms are everywhere in housing now. From lenders making mortgage decisions to institutional buyers deciding which neighborhoods to scoop up. BlackRock, that big giant investment firm that's scooping up houses all over the place, turning them into rentals. And while data can be powerful, it can also be dangerous. If the inputs are flawed, the outputs spiral. Zillow didn't just miscalculate. They created their own bubble by overpaying for homes and tricking their own model into thinking the market was stronger than it really was. The irony is that while Zillow thought they were exploiting inefficiencies in the housing market, it was really the market exploiting them. They assumed scale would protect them, that buying more homes faster would smooth out volatility. Instead, it magnified every mistake. And that brings us to today's housing environment. Mortgage rates are bouncing around the mid 6% range, affordability is stretched thin, and inventory is creeping up. If companies or individuals try to chase growth by ignoring fundamentals, they risk repeating Zillow's exact mistake, because the truth is, flipping homes on a massive scale looks great in a bull market, but the second conditions turn, it's a bloodbath. Zillow wanted to be the Amazon of housing. Instead, they became a cautionary tale. And while they retreated back to their core business, the ripple effects of their failed bet are still felt across the entire industry. It scared off investors, spooked competitors, and left homeowners wondering just how much control these big players really have over the market. So here's the takeaway, you guys. If Zillow couldn't bend the housing market to their will, neither can anyone else. And that's exactly why paying attention to the fundamentals, jobs, rates, inventory, and yes, even irrational/rational human behavior matters more than ever right now in 2025. For those of you who really want to stay ahead of those shifts, again, check out the Deal Watch in the description, because the next wave of opportunity in housing won't come from hype or algorithms. It'll come from understanding what's actually happening on the ground before everyone else catches on. Zillow thought they had it figured out. The market proved them wrong. The question is, will the rest of us pay attention before history repeats itself? We'll see you on the next one. Bye!